Synthetic positions with options are highly leveraged, zero or very small cost positions that duplicate the movement of the underlying stock. What makes these synthetics so attractive is that they are very low cost and are no riskier than holding a duplicate position in the stock itself. For example, synthetic long stock consists of purchasing one call and selling one put with the same strike and expiration on the same stock. Ideally, the stock should be as close as possible to that strike. So for example, if the stock's at 50, you would open a 50 long call and a 50 short put. The net cost of the two options should be zero or a very small cost, and in some cases, even a small credit. If the stock does rise above 50 per share, which is the strike, the net value of the synthetic position will duplicate that movement. So if the stock goes up 5 points and has a $500 profit, the option position would do exactly the same and would also show a $500 profit. However, instead of putting $5,000 into the stock, you have put zero or close to zero into the synthetic position. For many people, the concern here is that the short put is uncovered. But when you think about it, if the stock goes down, let's say 4 points, you're going to lose $400. And likewise, if you are holding a synthetic long stock position instead of stock, you're still going to only lose $400. In other words, the synthetic loses the same as the stock, just as it wins the same as the stock. The opposite position, which is the synthetic short stock, has the same structure, but the options are flipped. For example, if you want to open a synthetic short stock position, meaning that you expect the stock price to decline, you would open a long put and a short call. For example, a stock is at 50, you would open a long 50 put and a short 50 call. And here again, the cost should be zero or very little and may even be a credit. If the stock does decline, the short call is going to lose all of its value, but the long put will track the stock point for point. So if the stock were to decline from 50 down to 44, the stock would have been worth 6 points less, but because you're working with a long put, for each decline in the price, the put will gain a point. And so in that scenario, the put would be worth 6 and the call would be worthless. The danger in the synthetic short stock is that the stock might rise. In that case, the short call would be a loss position and the long put would expire worthless. And so, although you expect the stock to go down, it might go up. This position, the synthetic short stock, has the same risks as shorting stock. However, shorting stock is expensive and complicated, and you have to pay interest on the borrowed stock to your broker. But with a synthetic short stock position, you can get the same exposure in the market and the same benefits and advantages for zero or very little cost. Synthetic short can also be made less risky if you also own 100 shares of the stock. In this case, you would have 100 shares, you would have a long put and a short call. The put and the call cost is little or nothing and may be a credit, and so you spend nothing on the options. And if you're right and the synthetic position does decline along with the stock declining, then the loss on the stock would be offset by gains in the put. At the same time, if the stock were to rise, the risk of the short call would be covered because the worst outcome could be that the stock would be called away through exercise of that call. And so just like a covered call, you have no risk except the lost opportunity that you would have by simply owning the stock. Synthetic shorts are appropriate for people who want to protect paper profits and are concerned that the stock might decline, but at the same time are willing to accept exercise in that covered position. Synthetic short and long stock are great examples of highly leveraged, low-risk positions. Low risk means that the risk is identical to the risk of owning stock. It doesn't mean that there are no risks. However, it's appropriate only if you understand all of the outcomes that are possible. And if you do, then synthetics offer a wonderful opportunity to vary the way your portfolio behaves. You can protect paper profits with the synthetic short. You can take advantage of potential rises in price with a synthetic long. So depending on what your perception is of what the stock is likely to do, you can look at synthetic long and short positions and take advantage of the nature of the options market.